Welcome to the Pro Ticker Deep Dive.
It's great to be here.
I want you to close your eyes for a second. Imagine looking at your brokerage account on your phone. It is February 2026.
Okay, I'm with you.
You see green arrows, you see the S&P 500 hitting record highs, you see the tech sector absolutely flying. By all traditional metrics, we are in the middle of a rager. Golden age.
It looks fantastic on the screen.
It does. But then you lock your phone, you walk outside, and you talk to your neighbor, or better yet, you look at your own credit card bill, and suddenly the music stops.
It's a jarring disconnect, isn't it?
It really is. The vibe is, well, it's just wrong. It feels off. And that is what we are digging into today. We are looking at a market that looks bulletproof on a chart, but feels incredibly fragile on the ground.
I think fragile is the perfect word. We are in the middle of a massive vibe shift in the 2026 economy.
Yeah.
And to understand it, we have to, look away from the stock tickers for a minute and look at the actual behavior of human beings.
Because for a few years there, the consumer was this unstoppable force, right?
Completely unstoppable.
We had revenge travel, revenge dining, revenge spending on literally anything that wasn't nailed down. But that energy has shifted.
It's a huge shift. And we aren't seeing a total collapse. People aren't retreating into bunkers. But we are seeing the rise of what I want to call the rational consumer.
The rational consumer. Okay, unpack that for me.
Right. And rational in this context doesn't just mean smart. It means calculating. It means the era of blind emotional spending is, for the most part, over.
So people are thinking twice.
I think 3 or 4 times. We are seeing what the data calls check fatigue or inflation fatigue.
Check fatigue. I feel that in my bones. You go out for a casual dinner, you get the bill, and you just sigh.
Exactly. That's the feeling. The consumer isn't necessarily broke. If you look at the balance sheets, they're actually okay for many households. But they are annoyed.
Annoyed. I like that. They're just done.
They're done being taken for granted. There is a real refusal to pay premium prices for what people are increasingly describing as slop bowl quality.
Slop bowl. That is vivid. It sounds like something from a Dickens novel, but I know exactly what you mean.
We all do.
It's that feeling of paying $20 for a lunch that is, half cold, maybe is missing ingredients, and it was thrown together in 30 seconds.
And that slop bowl resistance is actually the key to understanding the entire stock market right now.
Which brings us to our case study. And I have to say, when I saw the research stack for this week, I thought there was a mistake. We are talking about the global economy, the Federal Reserve, AI, and our lead story is a burrito company.
Stick with me here. Chipotle Mexican Grill is the canary in the coal mine. It is the bellwether for the entire discretionary sector.
The bellwether?
I'm serious. If you want to know what the American middle and upper middle class is feeling right now, in February 2026, you don't look at GDP, you look at a burrito bowl.
Okay, I'm listening. You have my attention. But
Yeah.
we're going to go bigger than just lunch, right?
Oh, much bigger. We are going to connect this whole burrito drama to the K-shaped economy that is, frankly, getting even more extreme. We are seeing a phenomenon where even the wealthy are turning into what we're calling a cautious class.
The cautious class. I like that term. It captures that anxiety.
And we absolutely have to talk about the one big beautiful bill.
The OBBBA.
The OBBBA. It sounds like a spell from Harry Potter, but it is a massive economic variable hitting us right now.
Yeah.
It explains why things feel so distorted, so strange.
So it really is shaping up to be a year of turbulence and transformation.
Turbulence and transformation. I think that's the theme for travel, for investing, for everything.
So our mission today is really to unpack this disconnect between these, sky-high stock valuations and the reality of what's in the consumer's wallet.
Exactly. Let's get into it.
Okay, so let's start with the micro view. Let's start with the burrito. Take us into the Chipotle earnings room. This was for Q4 2025. What happened?
So if you were just skimming the headlines on your Bloomberg terminal, you would have thought everything was fine. They actually beat expectations.
On the top and bottom line.
Yep. Revenue came in around $3 billion for the quarter. Earnings per share, the EPS number everyone watches, was 25 cents, which beat the street's expectation of 24 cents.
The beat is a beat. Usually Wall Street throws a party for that. Champagne corks are flying.
Usually.
Yeah.
But then came the guidance. That moment in the conference call where the CFO looks at the year ahead, it was a total record scratch moment.
Okay.
I mean, you could almost hear the silence.
Okay, so what did they say? What was so bad?
Management forecasted that comparable restaurant sales for 2026 would be about flat.
Flat as in zero. Zero growth.
Basically zero. And you have to understand the context here. Wall Street analysts spend weeks, sometimes months, building these incredibly complex models.
Right. They're paid to predict the future.
And they were expecting growth of plus 1.86%. They had priced the stock for growth. So when a growth darling, a market leader like Chipotle says, actually, we aren't going to grow our same-store sales this year, it changes the entire narrative.
It's like a sports car company announcing they're only going to make minivans now.
It's a fundamental shift in identity.
Yeah.
And the market reaction was, I mean, it was violent.
How bad?
Brutal. The stock dropped about 8% after hours.
Yeah.
Instantly. And if you zoom out, which is even more telling, it is down roughly 33% over the last 12 months.
A third of its value gone.
Gone. For a company that used to be, for all intents and purposes, invincible.
So let's play devil's advocate for a second. Why is flat such a complete disaster? Is it just that the bar was set too high by Wall Street? Or is something fundamentally broken in the business?
It's the why behind the flat number that is terrifying investors.
Okay.
It's traffic. The number of actual human beings walking through the doors has declined for 4 straight quarters.
4 quarters. That's a full year of shrinking popularity.
Correct. For the last year, they kept their revenue numbers looking okay by raising prices.
The old inflation play.
Right. The burrito got more expensive, so even with fewer people buying them, they made the same amount of money. But you hit a wall with that strategy.
Of course.
You can only charge so much for chicken and rice before the consumer pushes back. Before they say, you know what, no, I'm going home to make a sandwich. And we have hit that wall.
So the price lever is broken, they can't pull that anymore?
Not without doing even more damage to traffic. If they raise prices now, they risk losing even more customers, and then you're in a death spiral.
So they have to pivot.
They have to pivot. And this brings us to their new strategy, which they are calling, in classic corporate fashion, the recipe for growth.
Which sounds like corporate bingo, but I assume there is some actual substance there.
There is, and it's a really risky pivot. For years, the whole game at Chipotle was protect the margins, keep the profits high on every single burrito sold.
Right, the premium brand strategy.
Exactly. Now, Chipotle is publicly saying we need to rebuild traffic before we rebuild margins.
Translation: we're going to make less money per burrito if it means getting you back in the store.
That's it in a nutshell. They are prioritizing bodies in the door over profit per body. And the way they're doing it is fascinating. It's a mix of heavy technology and some very clever menu psychology.
Okay, let's talk about the tech first. I kept seeing this acronym in the notes, HEAP. H-E-E-P. It sounds like the noise I make when I lift a heavy box. What is HEAP?
It stands for High Efficiency Equipment Package. And look, I know talking about kitchen equipment sounds incredibly dry, but this is actually where the war for the consumer is being fought. In the back of the house.
This is the front line.
It is. And they are accelerating the rollout of this package to 2,000 stores. It's a massive capital investment.
Okay, so what is in the package? Are we talking about slightly better spatulas, or is this more significant?
We are talking about fundamental changes to the physics of cooking inside a Chipotle. The centerpiece is the dual-sided grill.
Dual-sided, so like a George Foreman grill on steroids. For a whole restaurant.
In a way, yes, it's a great analogy. Think about the current bottleneck in any Chipotle at lunchtime.
The line.
And why is there a line? Often, it's because they've run out of chicken or steak.
Right. And you have to wait.
You have to wait. And the guy on the grill has to throw raw chicken down, wait for one side to cook, flip it, wait for the other side. It takes time. A dual-sided grill cooks both sides simultaneously. It drastically cuts the cook time for proteins.
So the chicken is ready faster.
Which means the bin on the line is refilled faster.
Which means the line moves faster.
Throughput. That is the holy grail of quick service restaurants. The biggest reason people walk out of a Chipotle isn't the price. It's seeing a line wrapped around the block and thinking, I don't have 20 minutes for this.
You just go somewhere else.
You do?
Yeah.
If HEAP can cut that wait in half, they capture all those sales they were losing to impatience.
And I saw something about avocados, too. Are we getting robot-made guacamole?
We are. It's called the Autocado.
You have to be kidding me. That's the real name. Autocado.
That is the real name. And it's an automated make line for avocado processing. Think about it. Peeling and pitting avocados is incredibly labor-intensive. It's messy. It's slow.
And you need a skilled person to do it quickly.
Right. The Autocado automates a lot of that prep work, so you have less time spent in the back scooping green stuff and more time on the line serving customers.
And I'm guessing it helps with consistency, too.
That's the other part of the slop bowl complaint, isn't it? Inconsistency. One day the guac is great, the next it's not, Automation helps solve that. It delivers a more consistent product every single time.
Okay, so they are speeding up the kitchen with Heap and Avocado. But you mentioned menu psychology. I feel like I've seen more ads for limited time offers lately. Is that part of this?
It is a huge part of it. They are changing their innovation cadence.
Their cadence.
Right. They are moving from doing maybe 2 of these limited time offers, or LTOs, a year to 4.
So the chicken al pastor comes back for a bit, then maybe a brisket, then something else new. It's constant novelty.
It keeps the brand top of mind. It gives people a reason to come back other than just have it. But the real psychological weapon they are deploying, it's something called the protein cup.
A protein cup. This sounds like something a bodybuilder eats in their car in the gym parking lot.
It kind of is.
Yeah.
But it's brilliant. It's essentially a single taco's worth of filling, or a small cup of just meat or tofu, and it's priced under $4.
Under $4. That is a massive departure for them.
It's a game changer.
Usually you walk into Chipotle, you are mentally committing $15, maybe $20 if you get chips and a drink.
Precisely. And that $15 price point is a huge psychological barrier when people are suffering from check fatigue.
Right. Do I really want a $15 lunch today?
By offering a $4 option, they're widening the funnel. They're giving you an excuse to say yes. And notice what they're not doing.
What's that?
They aren't becoming Taco Bell. They aren't doing the dollar menu, which completely cheapens the brand. They are offering a portion-controlled value.
It's so smart. It gives the consumer permission to say yes to Chipotle, even if they are feeling broke. You can tell yourself, oh, I'll just get a protein cup.
And maybe you buy a drink. Maybe next week you feel a little richer and you come back for a full bowl. It's all about increasing frequency without destroying their pricing power. It's a very, very difficult needle to thread, but it's their big bet.
Okay, so before we move off Chipotle, we have to address the weather, because every company loves to blame the weather when they miss their earnings. Who is Fern?
The Fern factor, yes. Winter storm Fern. And to be fair to them, it was a legitimate major weather event. It caused massive restaurant closures across multiple states in early 2026.
And they quantified the impact.
They did. Management explicitly said on the call that this is going to be a 100 basis point drag on their Q1 comps.
Hold on, let's translate 100 basis point drag from Wall Street speak. That sounds technical. What does that actually mean for the cash register?
It means they are losing a full 1% of their total sales growth just because of snow. So if they were on track to grow 2% in the first quarter, now they're only going to grow 1%. It's a significant hit.
So does that let them off the hook? Can the CEO just stand up and say, hey, it was snowed out, our business is fine, nothing to see here?
That is the multi-billion-dollar debate happening in investment funds right now. The bulls, the optimists, are saying, look, the underlying business is fine. Fern was a one-time event. Buy the dip. This is a temporary dislocation.
And the bears?
The bears say no, absolutely not.
Right.
Traffic was down for 4 quarters before Fern ever showed up. The snow is just a convenient excuse for a broken growth story.
So what's the final verdict from the street? Is Chipotle a trap or a treasure at this price?
Wall Street is completely split down the middle. One camp sees a classic value trap. They think margins are getting squeezed by this new strategy, prices can't go up, and the stock is still expensive relative to its actual earnings.
And the other side.
The other camp sees a coiled spring. They think the Heap automation, the new menu items, and their international expansion are going to pay off huge in 2027 and beyond. They're betting on the long game.
It sounds like a show-me story. They really have to prove it to the market now.
Exactly. And the reason we just spent so much time on this burrito drama is because Chipotle's customer base tells us something absolutely terrifying about the broader economy.
Okay, let's pivot to that. The big picture. The consumer. Who is actually eating at Chipotle? Who are we talking about?
This is where the data gets really, really interesting. 60% of Chipotle's core customers earn over $100,000 a year.
Okay, so this is not a budget brand. This is not a low-income consumer story. These are people with 6-figure incomes.
Right. These are people who should be feeling good about the economy. Their stocks are up, their houses are worth a lot, but they aren't. And we are introducing a specific term for this group, the cautious class.
The cautious class. Explain that. What does that mean?
We are seeing a massive sentiment drop where you would least expect it. Among high-income earners, and I'm talking to people making over $200,000 a year, the measure of negative financial sentiment jumped from 9% to 15%.
Wait, I have to challenge that for a second. You make $200,000 a year and you have negative financial sentiment. That sounds like rich people just complaining. What are they actually worried about?
It's not about being able to afford groceries. It's about stability and the future. They are looking at the cost of housing, which is still astronomically high.
Sure.
They're looking at the news and seeing constant white-collar layoffs in tech and finance sectors they work in. And most importantly, they're looking at their 401ks being at record highs and thinking, this can't last. The other shoe has to drop.
It's a feeling of fragility. They feel wealthy on paper, but cash poor in their day-to-day decision-making.
That's it, perfectly. And this anxiety is fundamentally changing where they shop. It's causing what we call a bifurcation in the retail landscape. The economy is splitting in two.
There are clear winners and clear losers.
The winners are the retailers who offer one of two things: extreme value or extreme convenience. That's it. So you've got Walmart and Amazon.
The two giants.
Right. Walmart is projecting continued dominance. Amazon is just vacuuming up all the spending from back to school to the holidays.
Because even if you are in the cautious class, you still need paper towels and vitamins, and you want them cheap, and you want them delivered to your door tomorrow.
But here's the stat that blew my mind.
Yeah.
The one that tells the whole story. Let's talk about Dollar Tree.
The dollar store?
Dollar Tree. They reported in their last earnings call that 2/3, 66% of their new customers earn over $100,000 a year.
Hold on, let me process that. 2/3 of the new shoppers walking into Dollar Tree are six-figure earners.
Yes, that is a staggering, landscape-altering statistic.
Yeah.
It completely upends the traditional view of retail demographics.
That tells me this isn't just a temporary recession trade. This isn't just, I lost my job, so I have to shop here now. This is, I have a good job, a very good job, but I refuse to pay $8 for wrapping paper at a fancy store when I can get it for $1.25.
Exactly. It is a permanent behavioral shift.
Yeah.
It is the rational consumer in action. They are trading down aggressively on commodities and non-emotional purchases so they can save that money for, well, we aren't sure what yet. Maybe paying down debt, maybe experiences. But they're making a calculated choice.
So if Walmart and Dollar Tree are winning the cautious class, who is losing them?
The middle. The retailers who are stuck in no man's land. And the poster child for this right now is Target.
Poor Target. Target. Everyone used to love Target. It was a happy place.
It was. But look at the numbers. Target is struggling with hemorrhaging traffic. Their comparable store sales are down 3.2%.
That is a lot for a major retailer. That's a huge drop.
They are getting squeezed from both sides. They aren't the cheapest on everyday items. That's Walmart. They aren't the most convenient. That's Amazon. And that experience of wandering around Target with a Starbucks latte that loses its appeal when you are hyper-focused on your budget.
The value proposition isn't there anymore for this cautious class.
It's not. They walk in, they see the prices on, say, laundry detergent, and they just walk out and go to Walmart. Target is stuck in the slot bowl zone of retail. Not cheap enough to be a value, not premium enough to be worth the extra cost.
Precisely. And this leads us to the biggest paradox of 2026. Because we have this cautious class tightening their belts, we have them trading down to Dollar Tree. And yet, the government is about to spray them with a fire hose of cash.
Yes. Now we get to the macro engine. We have to talk about the sugar rush.
The one big beautiful bill, the OBBA.
The OBBA. I really hope the historians keep that acronym. It's fantastic.
Me too, but let's get serious about what it actually does. This is a stimulus package, right?
Yeah. It is a significant consumer stimulus. But the mechanism is really important. It's not like the checks we got in the pandemic. It's coming primarily through massive tax refunds.
Largest in history, I read.
That's right. Now, why is this hitting in 2026 specifically? And why is it all coming at once?
Yeah. What's the deal with the timing?
It's a confluence of events. It's a combination of legislative changes that were passed a couple of years ago that are finally taking effect, and some IRS processing adjustments that are accelerating the payments. But the key for us isn't the politics behind it, it's the timing. This cash is extremely front-loaded.
Front-loaded how?
Historically, tax refunds kind of drift in over the spring. You might get yours in February, your neighbor gets theirs in April. But with OBBBA, 56% of these refunds are scheduled to be paid by March. 80% are paid out by mid-May.
Wow. So we are talking about a massive condensed injection of liquidity directly into consumer bank accounts right now, February, March, April.
Exactly. So just think about our cautious consumer. They're worried, they're shopping at Dollar Tree, they're cutting back. Suddenly, a direct deposit for $3,000, maybe $5,000 lands in their account. What happens?
They spend it.
They spend it. That is the sugar rush. We expect a massive but very artificial boost in GDP and consumption in the first and second quarters of this year. The economic numbers are going to look great on paper.
But sugar rushes end, and then you crash.
That is the danger. Come Q3 and Q4, that money has been spent. It's run out. And the underlying issues, the high prices, the financial anxiety, they're all still there. So we are predicting a crash, or at least a significant slump, in the second half of the year.
It's a volatility bomb dropped right into the middle of the economy.
It is. And it makes the inflation picture incredibly messy, just unbelievably complicated.
Where are we on inflation right now?
It's hovering near 3%. It's sticky. It just will not go down to that 2% target that the Fed wants.
And now you have OBBBA pouring gasoline on that fire for the next few months.
Precisely. But wait, there's more. We also have to consider the tariff variable.
Right, the new trade policies that are being debated.
New tariffs are expected to be implemented, and lower immigration is also expected. Now, usually tariffs raise the prices of goods, which is inflationary, but they can slow down growth, which is recessionary.
And immigration.
Lower immigration tightens the labor market, which can push wages up, which is inflationary, but it also slows overall potential growth. It's a tug of war.
It just creates this completely confused timeline.
Exactly. OBBA heats everything up in the first half of the year. Then the tariffs and the labor shortages might cool things down, or worse, stagflationize them in the second half.
I do not envy the Federal Reserve right now. What a nightmare.
Oh, the Fed is in an impossible situation. And by all accounts, they are totally divided.
Because half the data says cut rates, the economy is slowing and the consumer is hurting, and the other half says raise rates, inflation is about to come roaring back.
That's the dilemma perfectly stated. You have the doves on the committee looking at Target sales dropping and saying, we need to cut rates to save the consumer. And then you have the hawks looking at the OBBA stimulus and saying, if we cut rates now, with all this cash sloshing around, inflation will go to 5% overnight.
So what is the consensus? What are the markets actually betting they will do?
The betting markets are pricing in 2 to 3 rate cuts through 2026. But, and this is a really key point, it will be a shallow easing path.
Shallow easing. So for the listener, that means don't expect mortgage rates to drop to 3% again anytime soon.
No, not even close. We might go from 5% to 4%, but the days of 0% free money are not coming back this year.
And yet, and this is the crazy part, if I look at the stock market, the PE ratios are in the stratosphere. It's like none of this matters.
They are. The S&P 500's price-to-earnings ratio is somewhere around 26 or 27. That is a historic extreme.
And the Shiller-KP.
The Shiller-KP ratio, which is, a much better measure because it adjusts for economic cycles, is near 39.
For the listener who doesn't track the Shiller-KP every day, why does 39 matter? Is that high?
It's nosebleed high. It has only been this high 2 other times in modern history. During the absolute peak of the dot-com bubble in 2000 and the post-COVID peak in 2021. Both times were followed by significant downturns.
It means the market is priced for perfection.
That's the phrase everyone is using. Investors are betting that corporate earnings will continue to grow, that inflation will magically fall, that the Fed will cut rates perfectly, and that absolutely nothing bad will happen anywhere in the world.
It's a high-wire act with no safety net.
Exactly. When valuations are this high, the market has no shock absorber. If a big company like Chipotle misses earnings, it doesn't drop 2%, it crashes. If the Fed doesn't cut rates when expected, the whole market could have a tantrum.
And we haven't even mentioned the tail risks.
We call them tail risks because they are on the far ends of the probability curve. They're low probability, but high impact. Think about the Liberation Day tariff event from history. Nobody thought it would happen, and when that tariff shock hit, the market dropped 20% almost overnight.
And markets are notoriously terrible at pricing in political risk.
They ignore it. They completely disregard it until the press release drops. So, to sum it up, we are sitting on a powder keg of extremely high valuations with a consumer who is fundamentally anxious and a government that's about to pour sugar into the gas tank.
It is a wild, wild setup. So let's go back to our cautious consumer for a minute. Let's say they just got their OBBA refund, they bought some stuff at Walmart. Are they traveling? Because for a while there, travel was the one thing people would not give up no matter the cost.
That tide is definitely turning. We are seeing clear signs of strain in travel demand.
Is the revenge travel era officially dead?
I'd say it's on life support. The cautious class is starting to apply that same check fatigue they feel at the restaurant to their vacations.
How does that manifest? Are they just staying home and doing staycations?
Not entirely. They still want to go somewhere. The desire is there, but they are cutting the frequency. So instead of 3 trips a year, they take 2.
Okay.
They're cutting the length. Instead of a full week, it's a long weekend, maybe 4 days. And crucially, they are cutting in-destination activities.
The extras, the add-ons.
Right. You book the hotel, but you don't book the $200 snorkeling tour. You don't book the $90 a day cabana. You don't book the spa treatment. You sit by the pool and drink the beer you bought at the grocery store down the street.
So the hotels might see decent occupancy numbers, but their revenue per guest, their most important metric, drops like a rock.
Exactly. And the airlines are getting very worried about the road warriors.
Corporate travel, the business flyers.
Right. A recent survey showed that 53% of frequent business travelers expect to take 3 or more trips a month.
That still sounds like a lot of travel.
It is. But it used to be 63% just a year ago. That is a significant drop in the most profitable segment of their customer base. Companies are looking at their own slot bowl expenses and saying, why are we flying you to Chicago for a 2-hour meeting just to use Zoom?
But again, we have this theme of bifurcation, because I bet the Four Seasons isn't hurting for customers.
You would win that bet. Ultra luxury is completely immune. If you are in the business of selling hotel rooms for $1,000 a night or more, the average daily rate or ADR demand is rock solid.
Because the truly wealthy are unaffected.
The truly wealthy, not just the high earners, are completely unaffected by 3% inflation. It doesn't change their behavior at all.
So it's the mass market luxury that is suffering, the aspirational traveler.
The person who stretches their budget to feel rich for a week at a nice Westin or a W hotel, they are the ones pulling back. And that is a huge problem for airlines like Delta or United, who have built their whole strategy around upselling those people from a regular economy seat to premium economy for an extra few $100.
You can't upsell someone who is already tapped out.
You can't. And that revenue stream is at risk of plateauing.
Now, I want to talk about how people are booking these trips they're taking, because I feel like every time I open a browser now, an AI is trying to plan my vacation for me.
It's a massive shift, and it's very generational. Gen Z and millennials now dominate travel demand. They are 50% of the market, but they operate in completely different digital worlds.
Gen Z is all on TikTok, right?
Exclusively.
Yeah.
Over 50% of Gen Z uses short-form social video for their travel research. They don't go to Google and search best hotels in Paris.
No?
No. They scroll their feed until an influencer shows them a cool-looking room with a view of the Eiffel Tower, and they say, I want that one. It's entirely visual, discovery-based search.
The millennials.
Millennials. They are the AI generation. The usage of generative AI for travel planning tripled from 2023 to 2025.
Tripled. That is a ridiculously fast adoption curve.
It is exponential. They are using tools to build incredibly complex itineraries in seconds. Find me a hotel in Tokyo under $300 that is near a park, has a vegan breakfast, and is on a direct subway line to the fish market. AI does that in seconds.
I've heard about Expedia's Romy. Is that an example of this?
Romy is a great example. It's an AI assistant, a chatbot that helps you plan, but the buzzword you really need to know for 2026 is agentic.
Agentic, as in an agent.
Yes. Until now, AI has been a chatbot. It gave you information. Agentic AI has agency. It can do things for you without you asking.
Give me a real-world example. How does that work?
Okay, let's say your flight from New York to London is canceled due to weather while you are in the air. A chatbot can send you a notification that says your flight is canceled.
Which is not helpful. It's just stressful.
Right. An agentic AI running on your phone detects the cancellation, instantly scans all available flights on all airlines, finds the best alternative, books you a new seat, updates your hotel with new arrival time, and sends the new boarding pass to your phone before you even land.
It completely removes the friction and the panic.
It removes the panic. And for our conscious class consumer, that peace of mind, that guarantee of a smooth experience is incredibly valuable.
Okay, so we have the landscape. We have a fragile consumer, a bifurcated market, a government stimulus bomb, and AI agents booking our flights. The million-dollar question literally is, what do we do with our money? What is the investment playbook for 2026?
It's time to be tactical. I think the autopilot strategy of just buying the S&P 500 index fund and closing your eyes is very risky, given those valuations we talked about.
So let's break it down by sector. First up, AI, the biggest theme of the last few years. Is the bubble popping?
It looks bubbly. The charts are vertical, no question.
Yeah.
But unlike the dot-com crash of 2000, where the companies had no earnings, these AI giants are printing cash. Microsoft, Google, Amazon, they have fortresses of cash on their balance sheets. So it's not going to zero, but the trade is shifting.
Shifting from what to what?
For the last 2 years, the trade was innovators. Buy the chip makers, buy NVIDIA. That was the whole game. Now, the smart money is moving to the enablers.
The enablers? Who are they?
Utilities.
Boring old power companies, really.
Boring is beautiful in this environment.
Yeah.
AI data centers consume ungodly amounts of electricity. I mean, amounts that are breaking the grid. The grid literally cannot handle the demand.
So you buy the companies that make the electricity.
You buy the companies that generate the power, and you buy the industrials, the companies that build the transformers, the copper wire, the physical infrastructure of the grid. They are the next leg of the AI bull market.
It's the classic sell picks and shovels during a gold rush strategy.
Exactly. And the third phase is the adopters. Look for companies in otherwise boring sectors, like financials or healthcare, that are actually using AI to fire 20% of their back office, to optimize their workforce and dramatically increase their profit margins.
Ruthless but profitable for investors. What about the risks in the AI space? Is there anything that could derail this?
The AI gap is narrowing, and we have to look at China. There's a company called DeepSeek.
I've heard this name.
DeepSeek recently challenged U.S. dominance by releasing a model that was arguably as good as the top U.S. models, like those from OpenAI or Google. But here's the kicker. They built it for a fraction of the cost, and it runs faster and more efficiently.
So the U.S. monopoly on smart computers isn't guaranteed forever.
No. And if AI becomes a commodity, if it becomes cheap and easy to access from multiple countries, then the sky-high profit margins for the chip makers might start to compress. That is a major risk to watch.
Okay, let's talk about safety. Fixed income, bonds. For years, the mantra was cash is trash. Is that still true?
Absolutely not. The slogan for 2026 is income is back in fixed income.
So what kind of yields are we getting now on safe government bonds?
Yields on 10-year treasuries are expected to settle somewhere between 4% and 4.5%.
That is a solid, boring, predictable return.
And in a volatile world, boring is good. It's a hedge. Remember that OBBA sugar crash we predicted for Q3? If the economy slumps and stocks drop 15%, those safe bonds will likely go up in value. They are your insurance policy.
So the classic 60-40 portfolio, 60% stocks, 40% bonds, is it back from the dead?
We're calling it the 60-40 plus thing.
The plus being what?
Alternatives. You need things in your portfolio that don't share what the S&P 500 does on a given day. Private equity, real assets like infrastructure projects, and
international stock.
International, really. I feel like for the last 10 years, the advice has been just buy America, don't bother with the rest of the world.
That worked for 10 years. But now U.S. stocks are incredibly expensive compared to the rest of the world. International stocks, especially in places like Japan and parts of Europe, are much cheaper. And they are finally seeing real structural improvements. Japan is normalizing its economy after decades. Europe is recovering. The growth gap is narrowing. It might be time to send some of your portfolio overseas again. Okay, let's get specific. Let's do a quick stock watch list. Based on everything we discussed, the K-shape, the bifurcation, what names are popping up is interesting.
Well, in travel, I would stick to quality. The big legacy airlines like United and Delta, they have the global network and the premium cabins to handle the corporate slowdown better than the budget carriers.
A flight to quality, so to speak.
Right. In retail, a name I find interesting is Best Buy.
Best Buy. I feel like I haven't been in a Best Buy in years.
Think about the cycle. We all bought new laptops and monitors in 2020 for the pandemic and remote work. It is now 2026. Those laptops are old, slow, and dying, and the new laptops coming out are all AI-enabled PCs. Best Buy is perfectly poised for a massive tech replacement cycle.
That makes a lot of sense. And on the defensive side, Dollar Tree.
Dollar Tree is the ultimate defensive growth play. As the cautious class continues to trade down on everyday items, Dollar Tree just wins more and more market share.
And the avoid list, the one to stay away from.
For me, it's Target. Until they can figure out who they are they a value store or are they a premium experience store? They are going to keep losing traffic to both Walmart and Amazon. It's a classic value trap right now.
So let's zoom out for the final takeaway. We have covered a lot of ground here, from burritos to AI. What is the one core message for the listener who's driving home right now?
The message is, don't be complacent. 2026 isn't necessarily about a massive stock market crash, but it is about friction. The free money era is over for companies that can't prove their value. The consumer is smart, they are armed with AI planning tools, and they are tightening their belt, especially after that OBBA stimulus wears off later this year.
So the set it and forget it index fund strategy of the last decade might need a manual override.
I think so. It's a year for stock pickers. It's a year for value hunters. You have to actually open the hood and look at the earnings quality of the companies you own.
And here is a thought I want to leave everyone with as we wrap up. We've been calling this the rational consumer. We've talked about how calculating they are at Chipotle and Dollar Tree. But with this one big beautiful bill hitting our bank accounts in the next month or two, are we actually going to act rationally? Or are we just waiting for the next hit of dopamine?
That is the ultimate question, isn't it? We say we're cautious, we say we're worried, but you give us a check for $3,000 and we might just book that expensive trip anyway.
Yeah.
But when that sugar rush wears off in Q3, will the AI agents be the only ones left with any money to spend?
A sobering thought to digest, along with your protein cup. Thanks for listening to the Pro Ticker Deep Dive. We'll see you next time.
Goodbye, everyone.